Hello, welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. In today's episode, we're turning our attention to the State of the Union, the European Union, that is. Ursula von der Leyen has outlined her agenda for the year ahead, and we've pulled out the key takeaways for credit investors. Meanwhile, the UK faces a challenging political environment, though a state visit from US President Donald Trump could bring some tailwinds in the form of new investment deals. Across the channel, European growth projections are being revised upward, adding some optimism to the macro landscape. All right, let's get stuck in. The State of the Union, Europe's Vision Forward. On Wednesday, the 10th of September, Ursula von der Leyen delivered her State of the European Union address to the European Commission. She struck a bold tone from the outset, declaring that Europe is in a global fight, not militarily, but economically and politically, to remain competitive and sovereign in an increasingly polarized world. Though the European project is rooted in peace and integration, von der Leyen emphasized the urgency of enacting her Commission's legislative agenda. Unity was her rallying cry, but it was met with some dissonance, as audible dissent echoed through Parliament, and several no-confidence motions remain in the background. While the speech introduced new initiatives, it tied together major themes with implications for credit markets. Chief among them, energy independence. She called for accelerating the decoupling from Russian energy, deepening cross-border grid integration, and maintaining Europe's edge in renewables, with nuclear playing a central role in providing baseload capacity. Digital and clean technologies also featured prominently. A new Cloud and AI Act, coupled with investments in quantum computing and semiconductors, aims to cement Europe's standing in the next wave of tech innovation. On the climate front, Brussels is backing rhetoric with capital, a €1.8 billion battery initiative, green procurement rules favoring made-in-Europe solutions, and industrial strategies designed to deliver both climate resilience and economic competitiveness. To support this shift, the Commission is doubling down on investment. A key initiative is the Startup and Scale-Up strategy announced in May 2025. It's a comprehensive plan to make Europe the preferred launchpad for tech firms, combining regulatory reform with funding mechanisms like Scale Up Europe and Tech EU program, and backing for the European Tech Champions Initiative 2.0 via the EIF. The EIB Group has since launched the Tech EU platform targeting $250 billion in mobilized capital by 2027. Beyond technology, there are broader goals to modernize Europe's capital markets. The Commission is advancing its Savings and Investments Union, something that we've spoken about in the past, which is a project to unlock household savings and channel them into productive assets. Plans include cutting red tape, deepening capital markets, and exploring a 28th regime, which is an optional EU-wide legal framework for scaling innovative firms across borders. Other elements of the speech touched on migration policy, housing support, and broader social initiatives, all underpinned by the recognition that public and private investment will be critical to delivering on these ambitions. What does all this mean for credit investors? Well, expect more EU-level borrowing and guarantees, which means continued growth in supranational bond supply. Utilities and grid operators may step up issuance to fund energy infrastructure. The push for affordable EVs and domestic supply chains could reshape funding dynamics in the auto sector. And increased regulation from digital platforms to housing markets may present new headwinds for certain business models. Big picture message: Europe is doubling down on security, sovereignty, and sustainability. The plans are bold, but execution speed remains a concern. Von der Leyen hinted at expanding trade ties with Mercosur, Mexico, India, and possibly CPTPP-aligned countries, signaling a shift towards building alliances and diversifying away from the US. The key for investors will be tracking how quickly proposals move from podium to policy and following the flow of funding. Whether you're positioned in sovereigns, corporates, or structured credit, the EU's evolving agenda will shape the investment landscape over the next several years. The standout initiative to watch next is the Savings and Investment Union. Now, turning to the UK. The UK government remains under pressure to ignite growth, a challenge that will only intensify in the run-up to the November budget. This week, US President Donald Trump is in the UK on a state visit, and according to Bloomberg, an investment agreement worth around $10 billion US is in the works, with a focus on tech, AI, and quantum computing, with NVIDIA and OpenAI leaders reportedly present, hinting at deeper cooperation. We'll dig further into this next week, but it may offer a welcome boost for the UK government. On the macro side, the picture remains mixed. GDP growth is stagnant, unemployment is creeping up, and inflation is stubbornly high. In August, the number of payrolled employees fell by 8,000, while jobless claims rose by over 17,000. Businesses remain hesitant to hire, awaiting potential tax changes in the upcoming budget. The unemployment rate held steady at 4.7%, though, and meanwhile, house prices are declining and manufacturing activity continues to soften. The Bank of England is widely expected to hold rates steady this Thursday, a decision driven largely by persistent wage pressures and elevated services inflation. Average weekly earnings are still rising above inflation at 4.7% in the latest figures. However, we expect the rate decision to be a mixed voting picture. So, is growth starting to turn the corner in Europe? Well, it's early days, but we are starting to see some encouraging signs. Not a boom, but certainly a shift in direction. In Germany, DIW Berlin has nudged up its outlook, now expecting modest positive growth of 0.3% in 2025, rising to 1.7% in 2026. It's not much, but it breaks a long stretch of flat or negative expectations. France is also showing a bit more momentum. The national agency INSEE has upgraded its 2025 growth forecast from 0.6% to 0.8%. That said, there are still headwinds. Consumers remain cautious, partly due to the budget uncertainty, and worries about job security are at a 10-year high, excluding the COVID years. Spain continues to be an outperformer. The think tank Funcas now sees the economy growing 2.6% this year, up from a previous forecast of 2.4%. Strong domestic demand and a solid Q2 helped push things higher. The main risk here is potential fallout from global tariff tensions, which could weigh on momentum later in the year. Even the UK received a small upgrade. In a Bloomberg survey conducted between the 5th and 10th of September, economists raised their 2025 growth expectations to 1.3%, up from 1.1%. But the outlook for 2026 still looks softer, with growth forecast to dip back to 1.1% in 2026, largely due to expected fiscal tightening in the wake of budget cuts. So where does that leave us today? Well, the bull market for equities in Europe appears to be losing a bit of steam, moving largely sideways recently. By comparison, credit has performed well, with indicators like the iTraxx crossover index now in multi-year tights, approaching pre-Russian invasion of Ukraine levels. The turnaround in growth projections back up the movement in credit markets as rates have declined in Europe and are arguably at a stimulative rate. Risks are still on the radar, but these are mainly focused on fiscal pressures. Credit remains one of the most compelling opportunities, particularly in comparison to equities and cash. That's it for this edition of the Credit Compass. If you enjoyed today's episode, don't forget to follow, rate, and share. And if there's a topic you'd like us to cover, please drop us a line. We'd love to hear from you. For deeper research and credit ratings, visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.